Stock markets around the world have closed above key resistance levels at the end of their week sessions, with even the UK market hitting new all-time highs this week. So how is this bull trap narrative continuing on in the markets? Let's take a look at some of the data showing how this could be turning, where those traps are involved, and also more data on the presidential cycle, which we'll get to in today's video. Now, it's the end of the week. We've all got places to be. So let's crack on with the video straight after you hit the like button, subscribe, bell notification icon, and also check out the links in the top of the video description. Our free crypto and economic report is coming out to you this week. Your home of macro cycle analysis across cryptocurrencies, the stock markets, commodities, and of course, the biggest of them all, the real estate cycle. Last year links here are, of course, our channel sponsors, Bybit, BitGet, and SwiftX. Huge sign-up bonuses still going on with these exchanges, and even having some free spot trading fees. So no fees when you trade on these particular exchanges. Go and check out the details down below. Guys, let's crack straight on with it. Let's first look at what's happening with the markets around the world coming into next week, what we can expect. Now, the main thing here on Forex Factory, which we like to look at to determine whether we're going to see any sort of volatility, this is where the narrative is moving in the news. We have CPI reading coming out next week. So this is Tuesday night, our time here in Australia, and of course, Tuesday morning in the US, or should I say Tuesday. Okay, so SPI, we got the core inflation data coming out. This essentially is just letting us know that we will probably see some volatility in the markets, those sharp moves up and down on a short-term time frame, very short-term time frame, probably on the minutes, maybe up to the hourly charts. It's important to keep track of what's going on here so that we can understand if we are seeing some short-term volatility, why that is happening. It's because some major news headlines are coming out. Otherwise, the trend is your friend, and at the moment, the trend is up. These markets have been closing above key resistance levels for the third straight week now. We can see the first week was January 23rd, the beginning of January 23rd, then last week, and now this week as well. Even though it was a red week, meaning we closed lower than last week, we're still above the previous low of last week and still just below the previous high. So basically what Gam would call an inside week. Now, why we're here, we want to look at how this bull trap is continuing on in the market, basically that narrative, even though we're starting to see some consistency with closing above these higher levels. Now, remember where we are just looking at the data in these markets, and then I'll give you my opinion at the end. If you've been following, which of course I believe you should be, we also have a more larger time frame roadmap that we are focusing on as well. We've been watching these markets come up. We have talked about the lows coming in June and October across the stock markets and Bitcoin, and we are anticipating on a more medium-term time frame a pullback into February or March. Okay, so we're looking around that time frame. That takes weeks to play out, but for now, we're seeing a bit of a pause after, in some cases, 5, 6, 7 weeks up from those December lows. So eventually, these markets have to hold pause, get some time to breathe, maybe correct a little, or maybe just hold out these levels before the move continues. So that's really important to understand where we currently sit in these markets, especially as we start to look at some of the other data that is also coming in here as well. Now, just going back to the current narrative before we get onto the bull trap narrative, because they all play in together. And the other piece of news that continues to come in is anytime we see the Fed talking, this also tries to spin the narrative up when all we have to do is just look at the chart. But essentially the other narrative that is here is, of course, the tech layoffs and why the media believes, which then the everyday retail believes, and then also some of the big money or the smart money out there, they also believe that the markets have to collapse. But we are looking like we're beginning to turn a corner. We'll get to that in the S&P and Bitcoin as well. But the layoffs that we've seen across the US, just to bring some of the numbers into perspective, because I want to look at this as objectively as possible before I give you my opinion, we've seen layoffs in the last month of January around 113,000. There's been consistent layoffs across the year of 2022. And of course, then we start to see the markets turn. Well, this is the Nasdaq. This is the tech layoffs. Okay, so there is a lot of fear around tech being laid off. That's going to lead to a collapse. and the markets are going to continue down further, just like what we saw in 2001 into 2002. Now, I want to just note the data here. 2 million people were laid off in 2001 compared to what we are currently seeing with last month being 96,000 or around 110,000. Add up for the total of the year, I think you barely hit 200,000. So 1/10 of what was happening in 2001. And remember, back in 2001, the Nasdaq was also much, much smaller. So there was less people in that sector, less people that have been trained up. So 2 million was a much bigger percentage of the overall market itself. So now we have less people being laid off, 1/10 of what would happen back there. And the market is essentially triple the size. If we just look at the data from the peak being around 4,800 to 1,200 points, so double and a half to the peak, obviously closer to that triple as well. So just trying to put the numbers into perspective, it is far less than what was going on back then. However, as you can expect, the news has to pump this up and then really try to ram home all of these layoffs that are happening, even though when you compare it to 20 years ago, it is a drop in the ocean. So let's go back. That's just looking at the specific data of the layoffs themselves. Then the technical data here for the Nasdaq is that we are closing above the previous swing tops, significant swing tops here, and also the bear market downtrend. And we're still above it on a logarithmic scale as well, which is a harder one to come back to because the gains need to be more and faster to the upside than they would be if we were on a linear chart. So it's above both of them at the moment. I am anticipating some sort of pause or a bit of a rollover here for the Nasdaq as well, because we've had some significant gains over this particular period here with a higher low coming in as well. This chart from Goldman Sachs is looking at investor sentiment around earnings, and it is deteriorating, or at least it has been deteriorating. It looks like it's turning the corner here, bouncing from the lows that we have seen during the pandemic crash and the GFC, which was 2008, 2009. So these low levels of investor sentiment around earnings, basically not feeling the greatest, not feeling too positive, feeling very negative around earnings, looks like it's bottomed and is now turning a corner. This sentiment reading has picked each of those significant crashes in the market over the last 15 years, basically the two largest crashes that we've seen since 2008. There was the bottom there, 2008, 2009, looking at this dark line of the 3-month moving average, looking at it again in 2020. And then after those bottoms, it basically skyrocketed on each of those occasions. Now, of course, I'm not saying that we have to skyrocket like we did last time. It wouldn't surprise this chart anyway, and the data here, even if we started to crawl our way higher, making higher lows and breaking back above, that's also acceptable. But potentially, we are turning the corner here. Investors have felt the worst they've felt around earnings, and we've seen those earnings come out from the US companies, US tech, US SP 500, and they've been bad. Yet the prices on the stock markets have gone up. The reason for that is, if you're following my Twitter, US earnings season is a report of past performance. So they report to us what's happened the 3 months prior. Stock markets are forward thinking and acting. We don't act on old news, or at least I hope we're not acting on old news. We're trying to piece together what's coming up for us next and then place our bets, or in this case, our trades, on what we think is going to happen next. That's why it doesn't matter about these earnings seasons. It's absolute waste of time trying to say, well, these companies, these tech stocks have had bad earnings all year, yet the market is bouncing from this point. It makes no sense when stock markets are forward thinking. You're always trying to anticipate what is going to be the next latest trend and the biggest thing to boom and bust. If you hear from altcoins and crypto, of course, that's what we do all the time. We're like, what's going to be the next narrative? What's going to pop off? This is going to be the next greatest thing. Why go and do the opposite when it comes to the stock market? It makes no sense. All of these markets are forward thinking. Don't worry about these potential past performance of their earnings in this case. Essentially, the market is anticipating that earnings have bottomed and will turn the corner in 2023. Now to the S&P, and we have just closed another week very close to the previous swing top here set back in mid-December, and the last 2 weeks have actually been rejected off the 50% level. So that key 50% level of the bear market decline. This is what we're looking at here, from the peak to the trough, and then splitting this in half right down the guts is 41.55. So that is still playing out as a key level, technically speaking, for the SP 500. You can see that we've had a bottom at this level, and that bottom came in before the final bottom came in. So that's pretty interesting to note that we're seeing a balancing act here happening at that 50% level. Now, there was also a top here in May, and now the market is starting to find some resistance here over the last 2 weeks at this level. So for the bulls, we just want to see a bit of a pause here or a pullback of sorts, nothing too severe, and then the bust above this level. For the bears, obviously want to see it rejected pretty hard and break this December low. That break of the December low is not good for the bulls at all, of course, but really it changes the structure, at least in the intermediate term, because if we do start to fall under this level and get trapped between 3,500 and around 3,800, that means it's just going to be a longer, slower grind for 2023. So for the bears, that's exactly what you want to see in order to at least hopefully test that downside of 3,500 and get to a lower price. For the bulls, you definitely want to see around 3,800 being held up, if this is the decline, of course, and then in quarter two, we start to break higher. Now, the last bull scenario is, of course, we just hold out at these levels, and then quite quickly, we start to break higher and then consolidate above this level of 41.55. So there's obviously a few scenarios, the up, down, sideways type scenario, but again, this is investing and you got to be prepared for all sides of the market. You don't go into a sporting event or any sort of war only looking at one side of the market. They're the fools. They're basically the guys who only read the titles of YouTube videos. You see them in the comment section. Thank you to you guys for watching to the end of yesterday's video and commenting bull trap all the way down the comment section. That got a few people fooled, as they were only reading the title and then the comments. Now, of course, I don't want to fool people, but I do want people to watch the videos and look at the data that's coming out, because there is a lot of key data here that shows what 2023 may be, I guess the probabilities of what 2023 could turn into compared to what the news is telling us, and I guess what a lot of people are hoping for, because they've missed out on bull runs before. They're hoping for much lower prices because everything is too expensive. I agree, everything is quite expensive, but we're starting to see a trend of some of these things coming down, at least in the short term. Now, just because I think they're expensive doesn't mean they're going to come down. I got to keep playing with what the market is giving me, and at the moment, the data around the third year of the presidential cycle is that we're probably going to see higher prices, or at least hold up at these prices in 2023. Essentially, the year of 2023 not being a negative year like what we saw in 2022. This is some of the data here, sourced from FactSet, Global Financial Data. You can see some of the dates here as well, as of May 17th of 2022. So history favors a positive 2023. What is the presidential cycle? Essentially, there's 4 years for a US presidency. The fourth year is the year of the election, so that is next year in 2024. We are in the third year of that cycle. This is the data from the third year. Frequency of positive returns, US president's third year. 9 out of 10 third year of the cycle, 9 out of 10 of those have been a positive return year, okay? Frequency of 2 consecutive down years, 7%. So we've had one down year, so that was last year. For another down year to occur, it's only 7% chance of that happening. So what sort of returns can we look out for in 2023? So if CPI has peaked greater than 5%, generally we see about a 12% return on the S&P 500. 2023 returns after a negative year. So last year was a negative year. We typically see about a 13% return. Average 12-month return after US midterm year. So last year was a midterm year. We see about an 18% return. Average 12-month return after negative midterm years. So last year was a negative midterm year. We see about a 20%. And for the last one here, I have to get rid of my face. Average 12-month returns after bear markets, about 49%. So that will possibly be from the low, looking at the low being in October. But nonetheless, even if we took some of these lowest percentages here, you're still looking at between sort of 10 and 20% return for 2023 with a possible 9 out of 10 chance of this happening. Now remember, nothing is perfect here, but they're pretty good odds, and I don't really want to bet against these sort of odds. So if we see good odds in the SP 500 and we're starting to see the Nasdaq bounce as well, and that data doesn't seem as bad, and in terms of the bottom signal here where we've seen it happen, this could potentially be the third time as well. What does that mean for Bitcoin? Well, it seems like Bitcoin may have also bottomed in a similar time period here around that November period, and we've obviously bounced away pretty significantly. So it is possible that any of these sorts of drops are reasonably good buy the dip opportunities. That's something that I've been also mentioning on Twitter, so make sure you do go and follow there. The links are in the top of the video description, just looking at Bitcoin and all-time highs and that sort of thing. So going back to Bitcoin here, these are the key levels that I'm looking out for in terms of dips: 20,700, 19,800, and then we don't really want to see the market go any lower than around 18,600. And if you really want to get that far down, probably these lows here at around $18,000. If it does go lower than this point, the structure changes, and this is no longer the start of a bull market, you know, that first high swing low. We basically drop back into this zone. So the bears hoping for $10, $12, $14,000 Bitcoin must see the market go under $18,000. If this move doesn't go under $18,000, then we're probably in a good position here to start to accumulate DCA, that old BTC, for that move up. So my opinion of the market is that we haven't seen the structure change yet. I'm not anticipating that the structure will change, but they are my levels in case the structure does change. A drop below 18K on Bitcoin, and for the S&P is a break of that December bottom. Same sort of deal for the Nasdaq as well. So far the structure is telling us that it looks like this is that transitional period that we've looked at before, basically the market trying to find its grounding level, which has basically been going on since around May, since that bottom came in May. And so moving forward from this point, I have to play my cards, my investment cards, as I see the market. And in terms of my own opinion of the data that I've extrapolated here and how I'm interpreting it, is that this is the start of the next leg up. We can be bullish in the long term, but then also be bearish in the shorter term, and that's precisely what's happening right now. And so I'm going to use this opportunity to DCA into some BTC. If you want to learn more about that, go and check out the links in the top of the video description. This is where the last of the shills come in. You've got our TIA premium members down here where I post about my altcoin positions, my Bitcoin position, my retirement fund portfolio, and we also do crypto trading for cash flow over there as well using our trading strategies. So link to that is down below, along with our channel sponsors, Bybit, BitGet, SwiftX, and don't forget that free economic report coming out to you guys next week. Thanks once again, guys. Hope you have a fantastic weekend. Let me know in the comments section with emojis what you plan to get up to this weekend. I'm going to go hit the beach, surf, spend time with family, and probably barbecue. I'll see you guys at the next video. Until then, have a great weekend. Peace out.